Hey Melissa, would you like to share something about yourself?
Absolutely. No, I'm happy to share a little bit about myself. So I've been in the mortgage business for longer than I'd like to admit, and started out working with brokers, taking all of their hardest loans and helping them figure out how to get them done.
Yes.
I spent several years after 2008 working in managing a government operations center. So I've learned in FHA inside and out, and then for the past 10 years I've worked directly with consumers, helping people to buy homes. So
Awesome.
these are some of my favorite topics.
Let's dive into that.
Yeah.
So in this market, we can help buyers with FHA and home ready program. Tell me, what are the criteria for FHA, like loan limits or the credit score limit? Can you tell us more into that?
Absolutely. So FHA does have lower loan limits than conventional, but they'll still go to a $531,000 purchase. So roughly the cutoff point for using FHA with the minimum down payment is about $550. So purchase price above that is going to require a bigger than 3.5% down payment. Below that, you can use the 3.5%. And as far as credit score goes, the minimum credit score to do a 3.5% loan, which is how people think about FHA, is 580. And it's going to vary a little bit lender to lender, but that's what we do. And the minimum score that we will accept is 540.
Wow.
Now, anything below 580 requires 10% down. But there are clients, I end up doing several of those every year, where people have very low scores but have the money to put down and are able to use FHA financing to get into a home instead of having to wait.
That's nice.
Yeah.
So with FHA, what are the fees that they have to pay other than mortgage insurance and other PITI?
There are no specific fees other than mortgage insurance that are unique to FHA. And FHA's mortgage insurance is why the product sometimes gets a bad rap.
Okay.
And the reason for that is you pay monthly mortgage insurance for the life of the loan, and you pay upfront mortgage insurance.
Right.
But let's talk about why that might not be the end of the world. So the upfront mortgage insurance, that's 1.75% of the loan. That gets financed into the loan, so it's not money that people are having to bring to closing, but it's additional equity that is being used to pay for this program. So if you don't need to use the loan, I would say that's the main reason why I would say let's look at conventional instead of FHA, because of that upfront mortgage insurance. The monthly mortgage insurance, people will say that's negative because it stays with the loan for the life of the loan. But almost nobody keeps a loan nobody even keeps a house longer than 7 or 10 years. And on a conventional loan, they'd still be paying mortgage insurance if they put 5% down. So at least for about 11 years. So I think that's really kind of a misnomer. And for people buying with an FHA loan, I usually try to help them make it step one of a 2-step process, so that step one is you buy the house with the FHA loan. Step 2 is you are going to either refinance that loan into a conventional loan, or you're going to sell the first house and then buy the second house with a conventional loan.
Right.
Because at that point, the buyers probably have a bigger down payment from the equity of their first house. And so because their down payment is big, maybe it's 20% and they don't need mortgage insurance at all, but maybe it's 15%. The mortgage insurance on a conventional loan is going to be minimal at that point. Whereas if we're looking at 3% or 5% down conventional versus FHA, a lot of times FHA is better as far as just the cost of the monthly mortgage insurance.
So tell me more about FHA rates. So if you compare it to conventional to FHA, does it help buyers with a lower rate?
It actually does. And it doesn't always, but right now, FHA buyers are getting lower interest rates. So an FHA buyer very often right now is getting a 7.125 rate.
Wow, that's nice.
And I know, did we ever think we'd say that? But 7.125 is a great rate. A conventional buyer is, even with perfect credit, is going to be somewhere above 7.5 in most cases,
So,
almost every case.
so the FHA does help with the interest rate as well to bring down the monthly payment.
Yeah, Yeah, very often it does. So that's another thing is, I think it's important to ask a client, what's your main objective? Is your main objective to buy a house and have the lowest payment?
Right.
Then FHA might make more sense.
Exactly. So if you want to start somewhere, you can start with FHA, where loans are smaller, but yet you have your first home.
Yes.
Right.
Yeah, and the goal is to help people buy that first home, and that's what FHA was designed to do.
Right.
And it was created back when there was, 20% down was basically the only conventional option.
Right.
So this really provided a way for people to buy before they had saved 20%, or for people who didn't have family that was able to give them 20%.
Cool. So now let's discuss Home Ready program.
Yes.
What are the criteria for Home Ready program?
Okay, so Home Ready was really kind of conventional's, Fannie Mae specifically, their answer to FHA. They saw, we want a piece of that market. So they came out with this program called Home Ready. It has a couple of characteristics that are different than FHA, and one is an income limit. FHA has no income limit. Doesn't matter, you could make $1 million a year and still use an FHA loan. Home Ready has an income limit of 80% of the area median income, which is just over $82,000 in our area. So you have to make less than that, or the qualifying income has to be less than that to qualify to use the program. But the two main features of the program are lower interest rates. So the loan level price adjusters that Fannie Mae and Freddie Mac have on all loans really start getting very expensive when you get into smaller down payments. So if you're looking at a 5% down payment or a 3% down payment, because conventional has given buyers the option of a 3% down payment for a long time, but that mortgage insurance is so expensive. Yes. And also the interest rate is so expensive. So they created this Home Ready product to just completely remove those loan level price adjusters. So that it gives a better interest rate, and then it also gives much cheaper mortgage insurance. So those are really the two benefits. Technically, it allows down to a 620 credit score, but that's very technical. Yes. You still have to get an approval. Exactly. And I would say it's really tough to get a conventional approval below probably a 660 credit score.
Right, and lower the credit score, higher the interest rate as well.
Not with Home Ready.
Right.
So with Home Ready, and actually they have in the last year, remember the whole drama about the pricing changes? Yes. What that really did is helped people at lower down payments, at higher credit scores, but also regardless of credit scores if they had lower income. So what is the lowest credit score they can qualify for Home Ready program? I think realistically probably a 660. 660 is the best. Technically 620. 620. If we could get an approval, a 620 score is good enough. So that's technically they have everything they meet with all the other criteria and everything looks good. They might qualify as 620. Okay. Yeah.
So what are the plus and minuses of FHA and Home Ready other than just the income part?
I think the income one is the biggest.
Okay.
So the income, and then can we get an approval with conventional? Okay. So if their income's below 82,000 and we can get an approval, I think most of the time we would go conventional. Now there could be a time, like let's say we're at a 640 credit score and we might have, the pricing might be okay, but the mortgage insurance is still going to be awful on that conventional loan. So it really comes down to looking at the specifics for each person. But I do think, generally speaking, if someone, between those two, if someone qualifies for Home Ready, we should definitely look at that, rule it out, or make sure that it is not more expensive than FHA. Again, because FHA does have that upfront mortgage insurance. So if we can avoid someone using that just for that purpose, we save them some equity, help them build equity faster.
Okay. Anything else you would like to add that will help buyers with FHA or Home Ready?
I think another just program that I think is good for first-time home buyers now is the mortgage credit certificate program. Are you familiar with that at all?
No.
Okay, so what that does is it takes the mortgage interest that a buyer pays, instead of it being a tax deduction, it turns it into a tax credit.
Oh, wow.
So that's gonna, because interest rates are high, this is a more valuable program than it was. Like during 20 and 21 and 22, when rates were super low, the benefit that someone would get from that tax credit on a 2.5% interest rate was just like nothing. I mean, not nothing, but $1,200. Okay, I mean, you're paying $700 for an additional closing cost to get $1,200. Most people, and it is $1,200 every year until you refinance, which they're never refinancing that rate. But now that rates are between 7 and 8, that adds up. I mean, now we're talking $4,000, sometimes $5,000 in annual credit. Paying $700 in closing costs makes sense to get that every year until you refinance. And even when you refinance, you can adjust the mortgage credit certificate program to be based off the lower interest rate. So as long as that person lives in the house, they get this benefit. Now, if it's somebody who is in a career where their income is likely to increase dramatically, there are some recapture things that have to be considered. But for somebody that has a normal salaried job that's just going to get normal cost of living adjustments, it's a fantastic program, and I think something that really literally every first-time home buyer that qualifies for it should be looking at, or their loan officers should be. They probably don't know about it because it's most people, when you say mortgage credit certificates, their eyes glaze over. So
yeah, many people don't know about this program, so
yeah.
That is good to know.
And it's one of those first-time homebuyer programs because so many of those programs come with higher interest rates. So yes, you get money for down payment, for your down payment or your closing costs, but it comes at a cost, which if it's the only way you can buy a house, I think is very valuable. It serves a great purpose, but if you don't need to use it, I think it's best to look at options, even if it's going to be a little bit uncomfortable, or you have to take money from a 401k, or you're not going to be able to go buy brand new furniture immediately. I think focusing on getting in with the lowest cost of ownership and into a loan program that's going to allow you to build equity and build wealth as quickly as possible, I think is important.
It's very important.
Yeah.
If you're looking into buying a home, reach out to us. We would love to help.
Check out the caption below for all of our contact information.
See you next time.